Hey everyone, in today's video I'm going to go over the cash flow statement, which is one of the three major financial statements. First, I'm going to explain what the cash flow statement is, and then I'm going to walk through an example statement. So to start off, the cash flow statement outlines how much cash a company generates during a period of time. Now the two keywords in this definition are cash and period. First, cash. The purpose of the cash flow statement is to convert a company's net income into cash flow by adding back any non-cash expenses, as well as adjusting for any other outflows or inflows of cash. Now the second keyword, period. Just like the income statement, the cash flow statement tracks results over a period of time. This is usually a year or a quarter. Now let's take a look at an example cash flow statement. The three categories included within the cash flow statement include cash flow from operations, cash flow from investing, and cash flow from financing. First, cash flow from operations outlines the amount of money a company generates or loses from selling its goods and services after all cash expenses are paid. Now the way this is calculated is by starting with net income, adding back any non-cash expenses, which typically include depreciation and amortization, and then subtracting out any changes in net working capital. Once we sum these all up, we arrive at cash flow from operations. Now if you're confused on why changes in net working capital has an impact on cash, I'll leave a link in the description below to a video explaining this topic. The second category, cash flow from investing, outlines the amount of money a company generates or spends by selling or buying physical assets and financial securities. Now the most common line item you'll see in this category is CapEx or capital expenditures. Third, we have cash flow from financing, and this outlines the amount of money a company raises or spends on issuing debt and equity securities. The two most common line items you'll see in this category are increases or decreases in debt or equity. So for example, if we raise debt, that will be cash coming into the company, and if we pay down debt, that will be cash leaving the company. And the same goes for equity. If we issue equity, that's going to be cash coming into the company, and if we buy back shares, that's going to be cash going out of the company. Once we add these two up, we arrive at cash flow from financing. Now once we sum up all three of these categories, cash flow from operations, cash flow from investing, and cash flow from financing, we arrive at the total change in cash for the period. Now to wrap everything up, the cash flow statement outlines how much cash a company generates during a period of time. And it does this by starting with net income and adding back any non-cash expenses, as well as adjusting for any other outflows or inflows of cash. Now after watching this video, I hope you have a better understanding of what the cash flow statement is. If you found this video helpful, please like and subscribe below, and I look forward to talking to you guys again soon.